All right, so today we're going to talk about manufacturing cost flows. As you can see, I've already put up here on the board the different T accounts you're going to want to use, right? So we have raw materials inventory, we have work in process inventory, we have finished goods inventory, cost of goods sold, and then manufacturing overhead. So these three, raw materials, WIP, and finished goods, are all inventory accounts. So we're going to treat them like we would any normal inventory T account, right? So it's going to increase as a debit, decrease as a credit. Same here, increase as a debit, decrease as a credit, increase as a debit, decrease as a credit. And then COGS is an expense account. So of course expenses, same thing, increase as a debit, decrease as a credit. And then manufacturing overhead is a unique account, a unique T account here because it's not really a real T account. It's more just like this holding area where you're going to add up your actual manufacturing overhead costs and then compare it to your applied, which we'll talk about how to calculate that here in a second. And yeah, so we'll get started from there. So raw materials inventory, you can think of it as like the shelf. So if we're making wooden chairs, for instance, think like we buy the wood and where do we put it? We put it on the shelf, right? And it just sits there until we're ready to use it. That's what this is. It's a shelf, it's just waiting to be used. Whether that's the wood or the nails or the glue, it's just waiting for its time to shine, right? When we're ready to use it, we'll move it into the WIP T account, which is like the factory. So this is where the actual chair is being produced or being made. And then once we finish it, obviously finished goods, it's kind of self-explanatory. And it's kind of the warehouse, right? When you finish making something, it's just gonna sit there until it's sold, which is then cost of goods sold. Okay, so when we start, we'll have our beginning amount of raw materials. We'll add our purchases to it. And they're not going to differentiate on the purchases whether they're direct or indirect. They'll just give you a total usually. And then what we're moving out of raw materials, right? Because if we're crediting it, we're decreasing our raw materials. So we'll be moving out either direct or indirect materials or both. Now, direct materials, as you can see, will flow straight into WIP right here. So direct materials. And the indirect materials will go down here to our manufacturing overhead T account. Okay, and let's see. Yeah, so down here, manufacturing overhead is going to be anything that's indirect. Because if it's a direct cost, meaning it has to do directly with the product that's being made. So it's the workers working actually on the chairs, and it's the wood being used on the chairs. If it's actual, it's a direct cost. It's going to go into WIP. If it's indirect, it's going to come down here. And of course, we're talking strictly about product costs, right? Because we're in the factory as opposed to like in the office building, which is period costs, right? Okay, so here we have direct labor, and then we have applied overhead as well. So we can go ahead and talk about how do we get applied overhead. So we're going to come down here to this formula. So we have budgeted overhead divided by budgeted hours, and that's going to give us our predetermined overhead rate. Now, another way they can phrase this, they can say estimated overhead over estimated hours. It's the same thing. But yeah, so don't be confused if they use estimated instead of budgeted. And then with the hours, it can be either machine or direct labor hours. And sometimes they'll say product A is one and product B is the other. So you just want to watch carefully, make sure you read the problem. And then once we get our predetermined overhead rate, then we're going to multiply that by actual hours. And again, you're going to want to stay with the same. If we were doing machine here, then we want to do actual machine hours here. And if we were doing direct labor hours here, then you want to stay and keep doing actual direct labor hours here. And then once we calculate that out, we get applied manufacturing overhead. Now, once we get this number, that is what goes here. And at the same time, it goes up here. So when we apply manufacturing overhead, there is a journal entry for that. And if we just look at our T accounts, we can figure that out. We say, well, where is it a debit? It's a debit to WIP. And where is it credited? So debit, credit, right? So it's credited here to manufacturing overhead, which I'm just going to abbreviate MO. So this here is our journal entry for applying overhead. Okay. So once we get that, we put it in here. And again, this applied overhead is just like an estimate. All of our actual expenses haven't rolled in yet, or our actual bills for how much direct materials or direct labor is, so we wanted to make an estimate ahead of time just so we could anticipate what the cost of goods sold were going to be. So we put that in here with direct materials and direct labor, what we finish will then be credited, and that will move, what we finish will be moved over here to the finished goods inventory T account, and then what we sell will move over into COGS. So that's all you need with those first three T accounts. But now we want to look at COGS, and we're going to have to adjust it because our actual and our applied overhead amounts are never going to be the same. And so we want to determine whether we're over or we're under applied. So if we put too much in here, which then flowed through too much. So our COGS is too big. That means we put in too much here, right? So we're over applied. Let's see. If we are over applied, and like I said, COGS is too big, then what do we need to do? We need to decrease COGS, right? So if we're over applied, our journal entry will be, we're going to credit COGS because we want to reduce it, and since it's an expense, it decreases on the credit side. And then we'll debit manufacturing overhead. Because ultimately what we're trying to do is get this difference to zero. So let's say this was $10 over. By debiting manufacturing overhead, we get the difference to zero. You guys all see that? So now the opposite will be the case if we are under applied. If we are under applied, it means our actual overhead ended up being more than what we applied. So by the time we get over here, our COGS is too little. And so what we want to do is increase our COGS. So it's just going to be the opposite of this journal entry here. So if we're under applied, then we're going to do a debit to COGS for the difference, and then we will credit manufacturing overhead. Because again, we're just trying to get this difference to be zero. And I think that's it. Is that it? Yeah? Okay. Make sure you know these T accounts, memorize them, what goes into each of them, and when you approach a problem having to do with this, that you fill out everything first before you look and see what the problem's asking for. And if you can do this, then you can do any problem that they give to you on the practice exam or on the test having to do with manufacturing cost flows. So, yeah, that's all.